If you invest the wrong way for 30 years, you don't lose in one dramatic crash. You lose quietly. A little underperformance here, a little inflation there, a little tax drag, few emotional decisions at exactly the wrong time. Then one day you wake up at 60 and realize the math was never on your side. Here's the uncomfortable truth. Most people fail at investing because they re-stupid. They fail because they follow advice designed to feel good in the short term, not advice built to survive decades. So what is the best long-term investment strategy? It's not the popular one, not the exciting one, not the one being sold to you this year. To answer that, we have to zoom out. Because long-term investing isn't about picking the next winner. It's about building a system that survives time, incentives, inflation, and your own psychology. And almost nobody explains it that way. Right now matters. We are living in an era of instant portfolios, apps that let you trade in seconds, social feeds that turn 19-year-olds into market geniuses, entire communities built around the next 10 times stock. Meanwhile, the global stock market has compounded at roughly 7 to 10% annually over the long run. Boring, predictable, relentless. That gap between exciting narratives and slow compounding is where most investors destroy their future. Let me show you how this actually works. Imagine it's 1980. You invest $10,000 into a broad index fund tracking the US market, something like the S&P 500. You don't trade. You don't time recessions. You don't chase oil, tech, gold, or crypto. You just reinvest dividends, add money consistently, and you wait. You wait through the crash of 1987, through the dot-com bubble, through the 2008 financial crisis, through pandemics, wars, and political cycles. By 2020, that original investment would have multiplied many, many times over. Not because you were clever, not because you predicted anything, but because you owned productive assets and you let time do the work. That's the foundation. The best long-term strategy is not about prediction. It's about ownership. Ownership of businesses. Ownership of cash flows. Ownership of global productivity. And most people don't invest that way. They speculate. There's a difference. Speculation asks, what will go up next? Investment asks, what will continue producing value decades from now? That sounds obvious. But incentives distort behavior. Financial media needs constant stories. Brokers need activity. Influencers need engagement. Buy a diversified portfolio and wait 30 years doesn't trend. So let's strip this down to the mechanics. Step 1. Understand what creates long-term returns. Stocks return money in two ways: earnings growth and dividends. Companies produce goods and services. They generate profit. Those profits either get reinvested to grow or distributed to shareholders. Over long periods, stock market returns roughly mirror earnings growth plus dividends. That's it. No magic. Now, layer inflation on top. If inflation averages 2 to 3% and nominal returns average 8 to 10%, your real return might be 5 to 7%. That gap is your actual wealth growth. Which leads to the first uncomfortable reality. If your money sits in cash for decades, inflation quietly taxes you. No headline, no drama, just erosion. So the first principle of a long-term strategy is simple. Own assets that outpace inflation. Historically, broad equity markets have done that better than almost any other liquid asset class. But here's where people get derailed. They believe higher returns require higher complexity. So they concentrate, they leverage, they chase themes. Instead of buying the global market, they try to outsmart it. Let's talk math. If you earn 10% annually for 30 years, $100,000 becomes about $1.7 million. At 7%, it becomes about $761,000. 3 percentage points doesn't sound dramatic. Over decades, it's catastrophic. Now flip it. If you reduce your return by 2% annually, which is common in actively managed funds, that same portfolio shrinks massively over time. This is why low-cost index funds changed everything. In 1976, John C. Bogle launched the first retail index fund through Vanguard. He was mocked. Critics called it un-American to settle for average. But average, minus high fees, beats most professionals over long periods. That's not an opinion. Over 15 to 20-year spans, the majority of actively managed funds underperform their benchmark after fees. It's not because the managers are dumb, but because fees, taxes, and turnover are mathematical friction. So step 2 of the best long-term strategy is to minimize friction. Low-cost index funds, tax-efficient accounts, minimal turnover, boring again. Now comes the part nobody wants to hear. Volatility is not the enemy. Your reaction to volatility is, look at history. In 2008, during the global financial crisis, markets dropped over 50%. Fear was everywhere. Headlines predicted systemic collapse. Investors who sold locked in permanent losses. Investors who stayed invested or continued buying participated fully in the recovery. The market eventually made new highs. This pattern repeats. Crashes feel permanent. They aren't. Your behavior determines whether temporary declines become permanent damage. Which brings us to asset allocation. You cannot hold 100% stocks if a 40% drop makes you panic. So the best long-term strategy is not maximizing theoretical return. It's choosing an allocation you can hold through a crisis. For younger investors with stable income, higher equity exposure makes sense. As you approach your spending years, adding bonds reduces volatility. Not because bonds are exciting, but because stability has value when you're withdrawing money. This is where hype collides with reality. Social media says, go all in, leverage, never sell, diamond hands. But real life includes job loss, illness, and family obligations. Risk tolerance isn't a meme. It's your psychological architecture. And here's the deeper mechanism most people ignore. Time in the market beats timing the market. Not because timing is impossible, but because missing just a handful of the best days dramatically reduces long-term returns. And those best days often occur right near the worst days. If you're out of the market during a panic, you will likely miss the rebound. Now let's widen the lens. The best long-term investment strategy isn't just about asset selection, it's about cash flow management. If you invest sporadically, emotionally, or only when things look safe, you sabotage compounding. Systematic investing, done monthly and automatically, removes ego from the process. You buy when markets are high, you buy when markets are low. Over decades, your average cost smooths out. This is dollar cost averaging in practice. It's not magic. It's discipline disguised as automation. Now let's address the uncomfortable comparison. What about real estate? What about gold? What about crypto? Each has a role. Real estate can produce income and leverage, but it's concentrated, illiquid, and management-intensive. Gold stores value but produces no cash flow. Crypto is speculative and volatile with unclear long-term regulatory paths. Broad equities represent ownership in thousands of companies adapting to technology, policy, and consumer change. That adaptability matters over decades. The global economy evolves. Companies that fail are replaced inside broad indexes. You don't need to predict the next dominant firm. The index adjusts automatically. That's structural resilience. And yet, most investors abandon this approach during extremes. In bubbles, they chase performance. In crashes, they flee to safety. Which leads to the final layer of long-term strategy, behavioral defense. Create rules before emotions arrive. Rebalance annually. Maintain your target allocation. Ignore short-term forecasts. Focus on your savings rate. Because here's the quiet truth. Your savings rate in the first 10 to 15 years often matters more than marginal return differences. If you invest $5,000 per year versus $15,000, no clever stock pick can compensate for that gap. Income growth, expense control, and consistent investing. It's the engine. Now let's talk about a risk no one markets. Sequence risk. If you retire and markets fall 40% in your first year of withdrawals, the damage can be permanent. This is why diversification and a smart withdrawal strategy matter more than chasing peak returns late in life. The best long-term strategy evolves. Aggressive accumulation in early decades. Risk management and income planning later. It's not static, it's adaptive. And here's the irony. The optimal strategy is widely known. Low cost, diversified index funds, global exposure, disciplined allocation, tax efficiency, long holding periods, yet it feels unsatisfying because it denies the fantasy of outperformance, replaces excitement with patience, but markets reward discipline more than brilliance. Over 30 or 40 years, the investor who avoids major mistakes often outperforms the one who seeks constant optimization. So what survives decades? Ownership of productive assets, low friction, behavioral control, and time. Not predictions, not headlines, not market gurus. The best long-term investment strategy is simple to describe, but difficult to execute. And it's brutally unforgiving if abandoned halfway. So the real question isn't whether this strategy works. History suggests it does. The real question is whether you can endure 30 years of boredom, volatility, and doubt without interfering. Because in the end, compounding doesn't reward intelligence, it rewards endurance. And most people underestimate how hard endurance actually is. Thanks for watching. If you found this valuable, consider subscribing for more content that cuts through the noise. See you next time.